All right, let's jump right into this explainer and unpack why 2026 honestly feels like a tale of two completely different economies. We're going to be pulling data directly from JP Morgan's 2026 Market Outlook, some fascinating consumer insights from Alex Partners, and the latest shifts happening in the global bond markets. This year is fundamentally defined by contradictions, and getting a grip on these opposing forces is absolutely crucial if you want to make sense of the world right now. Because whether you're trying to map out a household budget, manage a stock portfolio, or literally just buy groceries, the wild, contradictory forces of 2026 are going to impact your wallet.
Here's our roadmap for today. We'll start with the 2026 economic paradox, then look at the new era of frugality, the AI market supercycle, the great normalization, diverging global central banks, and finally, navigating the year ahead.
Starting right off with Section 1, the 2026 economic paradox, and what we're looking at as a K-shaped economy. So right now, the entire global economy is splitting into this massive K shape. If you picture a giant letter K, you've got one arm shooting straight up and another plunging downward from the exact same starting point. On that top arm, Wall Street is anticipating these massive double-digit equity gains, entirely fueled by record corporate spending. The corporations at the very top, they are absolutely thriving. But on the bottom arm, you have Main Street consumers who are rapidly slashing their household budgets. This isn't just a minor divergence, we are talking about a profound, real-time split between massive corporate wealth generation and deep household financial strain, happening at the exact same time.
Dubravko Lakos-Buchas over at JP Morgan hit the nail on the head when he called this a multi-dimensional polarization. Basically, what he means is that extreme risk and extreme resilience are hanging out in the exact same room. We have robust corporate spending, especially in tech, existing right alongside a softening labor market and incredibly cautious household spending. The whole system is completely split. So look, if you've been feeling like the economic headlines saying everything is booming, just do not match your personal bank account, you aren't crazy. We are literally living in a multi-dimensionally polarized economy.
Moving on to Section 2, let's talk about this new era of frugality and the structural reset of value.
Get this, according to a massive survey of over 13,000 consumers across 9 different countries, the swing toward lower plan net spending widened by more than 60% compared to last year. That lands us at a dramatic 18 percentage point gap between people planning to spend less versus those planning to spend more. Now, normally, you'd expect younger folks, maybe college students, to be the ones aggressively tightening their belts, right? But the real shocker here is traditionally wealthy, high-income earners and retirees over 65 who are slamming the brakes on spending. This pullback isn't just happening at the margins. It is happening at the absolute top of the consumer food chain.
So why the massive pullback? Well, consumers aren't just in a temporary cyclical dip, they're in a highly disciplined retreat driven by 5 main forces. First, persistent financial strain from inflation and pretty muted wage growth. Second, they are intensely scrutinizing value. Think about eating out. Nearly a third of global consumers feel restaurants just don't deliver value anymore. Third is reprioritization. Fourth, they've adopted this buy now, wait longer mindset, trading impulsive buys for extreme patience. And the fifth one is wild, the rise of GLP-1 weight loss drugs. This is actively reshaping the food industry. People on these medications are literally eating less, and that drop in caloric demand is sending profound shockwaves straight through the restaurant, snack, and grocery sectors, especially in the US and the Middle East.
Just think about it for a second. If you suddenly got a bonus at work today, what would you actually do with it? If you said you'd travel or just save it, you align perfectly with the vast majority of the global public. 32% of consumers would prioritize experiences like travel, and 31% would just pad their savings. Almost nobody is rushing out to buy more discretionary non-food retail goods right now. Groceries are actually the only traditional retail category globally expected to see net spending growth. And let's be honest, that's largely driven by food inflation, not because we're buying a higher volume of stuff. This is a total structural reset in how we perceive value.
Let's flip the script for Section 3, the AI market supercycle and booming corporate capital expenditure.
In stark contrast to the struggling consumer we just talked about, JP Morgan projects that the AI supercycle is going to drive above-trend earnings growth of 13 to 15% for the S&P 500 for at least the next 2 years. And this massive surge, it's being driven by what they brilliantly call FOBO, the fear of being obsolete. We're not talking about a couple of software upgrades here. Major corporations are pouring hundreds of billions of dollars into data centers, physical infrastructure, and silicon chips out of pure FOBO. They are genuinely terrified that if they don't buy into the AI supercycle today, their businesses simply won't exist 10 years from now.
Which creates a highly polarized winner-takes-all dynamic.
These AI investments are keeping markets near record highs, for sure, but it's leading to extreme crowding and concentration. Let's put that into perspective. If you have a standard 401k or a broad index fund, your retirement is currently resting incredibly heavily on the shoulders of just a handful of massive tech giants. The equity market is effectively splitting between AI haves and non-AI have-nots. The good news is, as we move through 2026, analysts do expect this AI momentum to eventually broaden out geographically and move from just tech companies into utilities, banks, healthcare, and logistics.
Which brings us to the engine driving all of this in Section 4, the Great Normalization and the reshaping of the yield curve.
For 3 straight years, the financial world had this giant, flashing red warning sign, the inverted yield curve. Under normal circumstances, right, if you lock your money away for 10 years, you expect a higher interest rate than if you lock it away for 2 months. That's just the risk at time. But during an inversion, short-term debt actually yields more than long-term debt. It's this weird, upside-down scenario that historically screams recession. But now, we've finally reached what's called a bull steepener. The curve has normalized because short-term rates have fallen, signaling a deliberate transition by the Fed toward a neutral policy, even while government fiscal policy is still highly expansionary.
So when the curve normalizes like this, it sends out massive shockwaves that dictate exactly who wins and who loses. Traditional banks, they're practically popping champagne right now. Their whole business model relies on borrowing money at cheap short-term rates and lending it out at higher long-term rates. As the curve steepens, their net interest margins expand beautifully. On the flip side, over-leveraged tech and commercial real estate companies are in for some serious pain, because even though short-term rates dropped, those long-term yields are staying elevated. Basically, the era of free money is officially over, leaving us with a persistent higher-for-longer floor on long-term borrowing costs.
Let's zoom out for Section 5, Diverging Global Central Banks.
A year ago, everyone thought the world's central banks would just hold hands, declare total victory over inflation, and cut interest rates together. Well, global energy shocks completely derailed that. Now everyone is charting their own course. The European Central Bank and the Bank of England, they operate under strict mandates for price stability, so they're holding rates firm to fight off inflation driven by imported energy costs. Japan is dealing with a totally different headache, stagflation fears, and a very weak yen forcing them to hike or pause. And the US Fed, they are the wild card right now, keeping the flexibility to selectively cut rates as they try to balance strong overall growth with a labor market that's slowly starting to soften.
Finally, Section 6. Navigating the year ahead and synthesizing this entire outlook. So, let's pull all of this together. We've got a frugal consumer, a booming corporate tech sector, a normalized yield curve, and an entirely fractured global central banks. Based on JP Morgan's asset class forecasts, gold is acting as a massive safe haven right now. We're looking at projections of gold soaring to $5,000 an ounce by the end of the year, driven by central banks hoarding it and investor anxiety over geopolitics. We also expect that AI adoption to broaden out and create real productivity boosts in legacy industries like healthcare and utilities. Traditional banks will keep expanding their margins, and in the currency world, analysts are actually moderately bullish on the euro against the US dollar, since potential Fed cuts might weigh on the dollar's overall strength.
The absolutely crucial takeaway today is that 2026 is a year where extreme risk and extreme resilience are just going to coexist. With the global economy booming in corporate tech while simultaneously retreating in household retail, I want to leave you with this question. How are you going to adapt your own financial strategy, your investments, your business, your daily budget to navigate this deeply split reality? Thank you so much for joining me on this deep dive into the 2026 economic paradox. Keep learning, stay focused, and I'll catch you in the next explainer.